Well, hello there. This is Bruce at Fleet Capital Management. It is Friday afternoon, early evening, the 19th of January, 2024. Market's closed. We're going to take a look at the market. I have a number of things that I want to show you. We're going to talk about stop management. We're going to talk a little bit more about volume, and I think you'll find this very interesting. Let me go here. Here we go. We always have to say the video presentation is intended for educational purposes only. The discussion of any security is not a recommendation to purchase or sell the security. I'm always available. Bruce at Fleet Capital Management, homepage of our website. Most important button for you guys is if you need to talk to me about anything and you want to talk one-on-one, just click this button and it'll schedule a call with me. This takes you to the market analysis page on YouTube. I mentioned that I have a new tracking system where I'm tracking the stocks that I purchase across the firm. If you are a group 1 or 2 client, you probably own most, if not all, of the stocks. The only reason you wouldn't own a certain stock is if there wasn't enough cash in your account when I went to make the purchase. But with this tracking system, this bottom line is the S&P 500. The top line is our performance. This is done by a third party, by the way. In November, I started this system November 1st. So for the month of November, S&P was up 9.13%. Our stock portfolio was up 17.3%, which is pretty fantastic. In December, the S&P was up 4.5%. We were up almost 6%, which is great. So far in January, and this is through today, the stock market's actually down 0.64% and we're up 3.86%. And I'll show this to you. I don't know if I'll show it to you every week or once a month, but I'll show you this tracking system so you can see pretty clearly how we're doing. Let's talk about volume for a second again. In the last couple of weeks, I've introduced you to volume analysis. I've explained to you that prices can get manipulated, but volume, it's pretty difficult to do. Volume is the footprint of institutional investors. And what I want to show you, this is today, this is after the close, just to drill this in so you understand how this works. MELI is one of the stocks we own. I've just picked a couple at random. It was up 3.86% today. So without doing volume analysis, we really don't know if that's manipulation or what it is, but it was up 3.86, which is significant, but its volume was up 78%. And what that means is institutions were adding to their portfolios because retail would never be able to push the volume. This is hundreds of millions of shares, maybe a billion shares. So it takes institutions to push it up. And that shows me there's institutional buying. Drop down here, Supermicro, you probably saw that it was up dramatically today. It was up 36%. Its volume was up 621%. Again, we can't do that. The big institutions, the multi-billion-dollar institutions. Here's a stock, Parsons, we only had one stock that was down today. It was down 0.17%, not bad. But even let's say it was down 3%, but its volume was down. So what that shows me is that institutions were not dumping this stock. If it was down, say 2 or 3%, and its volume was up 100%, then I know institutions are selling it. And that is a huge red flag to me to go look much further. Conversely, Builder was up 4%, but its volume was down 24%. So there wasn't a lot of excess institutional activity here, which means we'll have to wait and see if this is going to hang on to those gains. So again, just another piece of analysis that we do. All we're doing is looking for clues. Today, I'm going to talk a little bit about our risk management strategies. I'm going to go through it quickly just to introduce you to the changes I've made in our risk or stop management. And again, for brevity, I'll go through quickly, but if you want to dig any deeper, just click on that button on the homepage of my website, schedule a Zoom meeting, and I'm more than happy to go through anything in as much detail as you want. So, stop management, and I've mentioned this to you before. I've been doing this professionally for 38 years, and stop management is the #1 most talked about, argued about, complex, inaccurate science that there possibly is. Buying a stock, I showed you that last week. I've got all these rules of fundamental analysis and technical analysis. And if it passes my rules, I buy the stock. And luckily, most of them go up. So I know the analysis is working. But to get out of a stock, the stop portion of the analysis, there are no real rules around it. So I have been playing with different rules for decades, and what I've come up with most recently, the latest iteration, if you will, I think is probably the most interesting because it's very broad. There isn't one rule. And what I realized is there isn't one rule that works all the time. So let's kind of go across the board at those things that give us a suggestion that the price is going to go down. So if the 8 moving average closes below the 21-day moving average of a stock, we're talking about the stock, not the stock market right now, that's what I call a trigger. That would cause me to put some stop in. Also, if the DI, and I'm going to show you this to you on the chart, crosses above the DI, this is DI minus and there's DI plus. If the negative crosses above the positive, that's going to trigger. If the price itself closes below the 21-day moving average, that could be a trigger. There are a couple other things that happen when the Lux candle coloring turns purple. Remember, I said we don't know when it turns purple. It could just be catching its breath and consolidating before it continues a run, or it can be a transition between bullish to bearish. So when I see that, or if the Investors Business Daily composite rating falls below 85, those two things, those could trigger a stop, but only if one of these other factors are involved. So these alone, these give me caution, and then I'm paying very close attention to all the others. I'm watching for what's called confluence of 2 or more factors. If a stop is triggered, I will place a fixed stop below the recent swing point or 2% below that current price, whichever is closer probably. I will use trailing stops in some instances. I'm finding that's not the best way to do it. And all stops should be active, meaning live. Pipes is my trading system. That's the name of it. It's called Think Pipes. So they will be in the system. And then I watch it every day and I will remove the stop when it no longer applies. So I'm going to show you all of that. First, let's go to our matrix. Updated today when the market closes. We've got green across the board. Everything looks good. Most importantly, this is our bear market avoidance along with this. But again, group 1 works off of daily MAs, moving averages. Group 2 is a little bit more conservative, but it doesn't really matter when they're all up. If these were red, what that would tell me is group 2 can't buy any new stocks. Group 1 still can. So group 1 is a little more aggressive, and that's the difference. The VIX, which is the fear index, is at 13.3. It's up a little bit, but not a big deal. I'm not worried about that. Remember, we have rules on the VIX as well. So hopefully that makes sense. Now let's go to the chart. And first, let's look at the market, and then we're going to look at the stop management. Here's the S&P 500 on a daily chart. If you remember that solid white line, that's the recent high. That was just before the bear market that started in 2022. And I said, as we were getting close to this, it usually takes a few times before we bust through. And today, we busted through. We closed above that, so that we're now at a new all-time high. A couple things about that. And it was done with better than average volume. The white line is the 50-day moving average of the volume, and you can see it peaked. It's above that, so that's greater than average volume. Now, first, let's talk about this area. What we want to see, I mean, classic textbook technical analysis, is this price might go up a little bit next week, and then it'll come back down. And in technical analysis, we want it to test this line again. And what that means is we want the price to come down, hit that line, and bounce off of it. What that means is what was once resistance, meaning the ceiling, remember, is now support or the floor. That's classic technical analysis. Does it happen perfect like that all the time? No. It might come just a little bit below and then run back up, but I'm not going to be surprised if we see maybe a couple days up and then come back down to test it. That's normal. Now, one reason that I'm not turning bearish at all or have any anxiety over breaking a new all-time high, is if we look at the linear regression channel, we are nowhere near the top of that channel. So this is a very healthy breakout. If it was above that blue line, which is 2 standard deviations above the mean, well, then I would be a little bit cautious. But right now, looking at that, it looks fine. And we had volume, and everything else that I'm looking at looks fine. So this is the daily chart. Let's go to the weekly chart for a second. And I need to make some changes to the analysis. So bear with me one sec. That. Okay, here is the S&P on the weekly chart. And again, there's the all-time high. You can see it, and you can clearly see where it was. That was January 3rd, 2022. That was the absolute high before the bear market started. This is the bear market of 2022 right there, okay? And remember, in my bear market avoidance, if I were to, let's take this off for a sec. That blue line is the 10-week moving average, and the gold line is the 20-week moving average. Our primary bear market avoidance system is if the 10 crosses below the 20, which happened right there. Would we have had some losses? Yes, but we would have avoided all of this. Okay, so whenever I say the 10 is above the 20, that's what I'm talking about. There's the 10. Here's the 20. And that would have done a fantastic job. That's why I say pretty emphatically, we will never, ever suffer through a bear market again because of these new indicators that I put on. But I also did some more research, and I actually added one more level, which is the 2-week moving average. That's the white line. And if the white line crosses below the 20, which is the gold, that happened even a couple of weeks before my bear market indicator. We would be buying no stocks, adding nothing to portfolio, and tightening up our stops significantly. So that's on the weekly. That's the bear market avoidance, which is part of our stop management system. And now let me go back to daily, and we're going to talk about daily a little bit more. Okay, so what are the rules? Well, first of all, we only have one stock. I call it in the penalty box right now. When a stock closes, when the 8 moving average, which is right there, crosses below the 21, which is the blue, that triggers a stop. That's one trigger. A second trigger is if we are underneath what's called a chandelier exit strategy. It's like the ATR. It's very similar to ATR. That's another thing that can trigger a stop. A third thing that can trigger a stop, and I know this is going to be hard to see because this is, let me get rid of that crosshair, this because it's purple, but that purple line closed just below, actually up here, I beg your pardon, up here it closed below the blue, the 21-day moving average. So if I go back over here and show you those rules again, if the 8, which is the white, crosses below the 21, which is blue, that causes a stop. I haven't shown you the DI cross yet. If the price closes below the 21-day moving average. So that's what all this is. Here, the price closed below the blue. That's the 21-day moving average. That can trigger it. The 8 crosses below the 20. That can trigger it. Below this, what's called chandelier exit. That can trigger it. And down here, I'll make it a little bit bigger, is that positive negative DI. Right here, where that DI, the negative, the red crossed above the green, that can trigger. So what happened is I saw a couple of these things over one or 2 days, and I added a stop right here. That's what this white line is. And the price was coming down, and this was an appropriate place for the stop. And now you can see the price is heading back up. When all of these things that I just mentioned as negatives turn back into positives, I'll take it off. For instance, I think it was PSN. Yep. PSN is a stock we hold, was below the ATR value. The white crossed below the 20 moving average. So I had put a stop right down in this area. And then it went back up. It solved all of those things. So I took the stop off. The stop is always going to be in white. So that's how you'll know. The blue is our entry. This was our initial stop, but new stops I take off. Like if I go back to front door, there's the white. That is a current, that just shows me there is a stop in the system that could be triggered, whether I'm looking at the screen or not. If this price touches that, it's gone. The stock is gone. That's what I mean by in the system, in the Think Pipes system. Okay. And we've had some others. We've had some other stocks that triggered a stop and just didn't hit it. So the only one we still have in is front door, and it seems to be curling back up and doing very nicely. I'm happy with everything that I'm seeing. The other thing is in this down draft, going back to volume, look how the volume during that time was all below the 50-day moving average. So there wasn't a lot of institutional selling, not a lot of excess volume in there. So again, another reason that I'm not real worried. Okay, so that's the stop management system. It has 4 or 5 different moving parts because I realized that no one was perfect. And again, I went through it quickly for time, but if you want to discuss it and learn more about it in more detail, just let me know. Now, let me show you this stock, which had just an extraordinary day. This is a stock that I'm going to put linear regression back on. It looked like the 8-day was rolling down and could have potentially crossed the 21-day. And we had some negative days on above average volume. You saw that. And the positive DI, which is separating now, but it looked like the red was about to cross the green. And Zacks research had a certain sell rating on it. I mean, there were just a lot of things. It didn't break the rules yet, but it gave me a lot of caution. And that's what the first level of what I'm looking for. And I actually emailed a client who owns this stock in a separate portfolio that I don't manage. And I had just remembered that he had this stock. And I told him, I said, there's some stuff breaking down with this stock. I said, I'm not ready to sell it because it hasn't broken any of my rules yet. Close, like yesterday, and again, this might be hard to see, but that little tick, that little green tick, that's where it closed yesterday. It is sitting on its 21-day moving average. If it had been down here and was below the 21-day moving average, I would have had a stop in the system, but I didn't. And luckily I didn't, because they revised their guidance, it's called, their guidance on sales and earnings. And Barclays Bank analysts raised their expectation for the stock, and the stock just went through the roof. It was up 36% today. So everybody should be very happy with that. But again, all this stuff is stuff I'm watching very closely. This little circle back here, I was putting a stop in. I can take the circle off because I don't need it anymore. But these are places where I was putting a stop in, and then it came down, and then it was purple. That doesn't make me put a stop in, but the fact that it had closed below the 21 did. So I had so lots of things. So there's a lot of ways. The bottom line is, I know this can be confusing and I'm going quickly, but the bottom line is, for both the overall market and each individual security that we have, there are so many systems in place now, and those systems were created out of the last bear market. And we did fine in that bear market. We didn't do great, but we did fine. We didn't go down anywhere near as much as the overall market, which is good. But I didn't want us, you or I, to participate in another bear market at all. So the research that I did created all of these new systems, and these new systems are rules. They are hard and fast rules that I follow. And part of my background makes it very easy for me to follow these rules. I'm a pilot by hobby, but I got my regular pilot's license, and then I got my instrument rating, which is very difficult. Then I got my multi-engine rating, and then I got my commercial pilot's license rating. And what that does is, to be a safe a really safe, a really good pilot, you learn to look at the information your gauges are giving you, interpret it rapidly, and act on it. That's what a great pilot does. And so I have created these rules as if when I'm looking at this and it's moving very fast throughout the day, it's like I'm looking at an instrument panel in an aircraft. So that's just my belief. That is my philosophy on how to do things. And what that means is we're not going to experience a bear market together again. We'll be sold out of them. And each individual stock, you can see there's no stop on here right now. There's no stop on Builder right now. It would be white. There's no stop on CRM, which is a new stock we bought, and it's doing very nicely. There's no stop on Crowd, which we bought way back here, and it's doing fantastic. And that's because I don't believe we need a stop unless the instruments are telling us that we need to stop. We want these things to grow as much as they possibly can. And the last thing I'll show you is, if I go over here to our portfolio, and let me move this out, and this is updated. This gets updated every minute. And when I tell you, if I ever say in the afternoon letter that our collective stocks outperform the S&P, today, and today is an outlier, but today our stock portfolio, meaning everything here, was up 4.16%. And if you look over here, the S&P 500 was up 1.23%. So whenever I say as a collective, the firm's stocks outperformed the S&P, this is where it came from. But if you look here, Crowd, we're up 56%. SMCI, we're up 43.5%. Massey, we're up 33%. Builder, we're up 29%. Macrolibre, we're up 27%, and so on. We've got some fantastic. Who says this isn't going to go up to 75% or 100% or 150%? No one. So we're going to, some people say, actually William O'Neill at Investors Business Daily, when he was alive, he said, if a stock goes up 20%, sell it. And that was one of his rules. I don't subscribe to that rule. So I want to let our profits run as much as they possibly can. I'm watching them very closely every day that the market is open, and I have very clear rules whether a stock needs to go in what I call the penalty box or a stop put in. Okay, so that's a story. Again, sorry for going fast, but it's a lot of information. I just want you to have some comfort. It doesn't mean we'll never have a loss. That's not what it means. But what it means is we're never going to ride through a bear market. We're never going to let something be up 60, 70, 80% and then lose 50%. That's just not going to happen because of all these rules. So if you want to dig deeper into any of this information, please let me know. If you like this kind of education, let me know. If you don't, if it's boring as hell, let me know. I do these videos not for me. I do them for you. So if there's anything in particular you would like me to cover, please let me know. I don't get enough feedback on that, and I would love to get more. So that's a story. Have a wonderful weekend. I hope you are warm where you are. It's been pretty cold all over the nation. If you're a football fan, this is going to be one heck of a great weekend. And I will be back with you on Monday morning, bright and early. I'll see you then. Bye-bye.